Hey, welcome back. It's Jason Walter here. In today's housing market update, I'm going to share the latest news regarding mortgage interest rates in the US because they have dropped lately. I'll also share what effects that's having on our US housing market, and then stick to the end of this video because I'll give you my honest opinion about all of this. Lots to cover in today's video, so before that, please hit the like button. I greatly appreciate that. That helps support the channel, and also consider subscribing if you haven't done so already. I post videos about how this pandemic is affecting our housing market. The biggest housing market news that I have to share was announced today from Freddie Mac. So for the third consecutive week, mortgage rates managed to remain under 3%, dropping 3 basis points last week to an average of 2.96% for a 30-year fixed-rate mortgage. A year ago at this time, the 30-year fixed-rate mortgage averaged 3.26%. In addition, the average for a 15-year mortgage is currently 2.30%. 1 year ago, it was 2.73%. Mortgage rates have been following the trend of the 10-year U.S. Treasury note. That yield peaked this year towards the end of March when the yield was about 1.75%, but now it has dropped to around 1.6%. Sam Cater, who's Freddie Mac's chief economist, said consumer income and spending are picking up, which is leading to an acceleration in economic growth. The combination of low and stable rates coupled with an improving economy is good for home buyers. It's also good for homeowners who may have missed prior opportunities to refinance and increase their monthly cash flow. However, even for home buyers who have a hefty down payment and are well qualified, buyers in general are having a hard time purchasing a house this year due to a drop of houses for sale and rising home prices. A possible side effect of low inventory and high prices is a drop of mortgage applications for home purchases. This is because the Mortgage Bankers Association announced yesterday that purchase applications fell for the second straight week. This caused the total number of mortgage applications to decrease by 0.9% from 1 week earlier. I did some research regarding this and found that the drop of mortgage applications has been a recurring trend because total mortgage applications, which includes refis and purchases, have decreased 8 out of the last 10 weeks. However, the MBA's unadjusted purchase index is currently 24% higher than 1 year ago when this pandemic was in its early stages. Joel Kahn, who's one of the associate vice presidents of the MBA, stated the following: both conventional and government purchase applications declined, but average loan sizes increased for each loan type. This is a sign that the competitive purchase market, driven by low housing inventory and high demand, is pushing prices higher and weighing down on activity. The higher prices are also affecting the mix of activity with stronger growth in purchase loans with larger than average balances. I have some more housing market updates to share with you, but let me first share my thoughts about what we've learned so far in today's video. I honestly cringed when I learned that mortgage rates dipped again, and now we're in the third consecutive week with rates below 3%. In my opinion, the housing market right now is not sustainable. It's not normal for home prices to reach record highs in March. It's also not sustainable to have 20% year-over-year home price growth. These lower rates should further increase home buyer demand, causing home prices to increase further. What we need right now is something to cool off this red-hot housing market in order to have a more balanced real estate market between buyers and sellers. So this could be from a variety of factors, which could include rising interest rates and/or a significant increase of housing inventory. In regards to rates, it appears that they will remain low until the foreseeable future. Most of the forecasts that I've personally seen have been in the 3.5% to 3.7% range by year end. But honestly, it's anyone's guess. But I saw that the National Association of Realtors recently posted that they are forecasting that mortgage rates are going to average 3.2% in 2021. That's after the Fed's recent announcement that they're going to keep the federal funds rate at or near 0% until the foreseeable future. And then this happened. Janet Yellen, who is the U.S. Treasury Secretary and former chair of the Federal Reserve, said this week that rates may have to rise in order to keep the economy from overheating. She stated the following: "It may be that interest rates will have to rise somewhat to make sure that our economy doesn't overheat. Even though the additional government stimulus spending is relatively small relative to the size of the economy, it could cause some very modest increases in interest rates." Let's take a step back here because let's be clear here, because she does not set the federal funds rate, nor does she set mortgage interest rates. Instead, the Fed sets the federal funds rate, and that's loosely tied to mortgage rates. CNBC reported that later in the day, Yellen tempered her comments somewhat on the need for higher rates, saying she respects the Federal Reserve's independence and was not trying to influence decision-making there. Yellen chaired the Fed from 2014 to 2018, and she said, "It's not something I'm predicting or recommending. If anybody appreciates the independence of the Fed, I think that person is me. And I note that the Fed can be counted on to do whatever is necessary to achieve their dual mandate objectives." In the meantime, the Federal Reserve has kept the federal funds rate at 0% for over a year now. Okay, changing gears slightly, let's talk about the national eviction ban because I'm getting a lot of comments on my channel about how it was overturned and how evictions are going to flood the market. If you didn't hear, a federal judge overturned the CDC's national eviction ban yesterday at the time of this video. The effects of that could have caused millions to be forced out of their houses, and that would have been 2 months earlier than planned. To give you a brief background regarding this, the CDC banned most evictions across the country, and that protection was slated to expire at the end of January. But President Joe Biden extended it first until April and then later through June this year. But within 1 day of this ruling by this federal judge to end the national eviction moratorium, the Department of Justice quickly moved in and appealed it. What this means is that the eviction ban will remain in effect throughout the court battle, and it's anyone's guess how long that will take. In other news, the Duke and Duchess of Cambridge started a YouTube channel yesterday and posted their first video. I just may subscribe so I can hear Prince William say, "If you enjoyed watching this video, then please hit the like button. We greatly appreciate that. And also consider subscribing and we'll keep you updated with new developments." Kate and I hope you have an awesome day and we look forward to seeing you on the next video.